Welcome, everyone. Again, like Jennifer said, let's keep it really informal. If you have a question that pertains to your business, we're happy to engage those questions as we go through the presentation. So, where I want to kind of take this conversation is really from the get-go. So starting with the business plan, cash flow analysis, moving through sort of how do we finance growth. There's different solutions for different stages of a business. As a company grows, there's just different alternatives in terms of where they are on the risk return curve. And so at the very beginning, a lot more is generated through family and friends, angels. It's a lot more equity based because it's a lot riskier. And so as that company grows, they move past that risk curve. They get into more potentially the venture capitalist. We get into bank lending. We do BDC. That's kind of where we want to make sure that we provide the solutions at the right company stage for that business. So we're going to also go through some of the key ratios that a bank would look like. Those are really important to know when you are making business decisions and what your cash flow is going to be looking like. You'll know upfront what we want to see in terms of some of the ratios we consider. We'll go through the loan application, protecting your business. I also spent 5 years in the insurance industry, so doing a lot of risk mitigation for companies. So I do have a slide on that because at the end of the day, if an accident does happen and there's just not enough protection, that can also unfortunately really affect a business. So, business plan. I know I talk to entrepreneurs all the time about this, and I can get a lot of pushback when we chat about the business plan because people are really telling me, Devon, the market's moving too quickly. By the time I do that research, it's outdated. I don't know why you want a 25-page plan when the things are just moving too quickly. It's internet-based. We're going global. I don't need this. I don't need to. And what I always share is, look, the business plan highlights a number of key factors that we're going to want to know, a lender's going to want to know, as well as the business owner. I mean, in terms of the structure it provides you with, the competition analysis, that you look at your competitors, what they're doing, you're able to see your strengths, your weaknesses, what are you able to do about your weaknesses. It doesn't need to be 25 pages. I've gotten business plans that are 7 pages and they're rock star. So it just really is a great way to tap into understanding where you're adding value, how your competitors are adding value, where you're different, and why investors, banks, et cetera, should be investing and working with you. I've had companies actually provide their business plan to partners. So their customers are asking for their business plan, wanting to know, do we want to partner with you? So it can be a huge tool to use. What we're looking for in a business plan, management experience. So how long has that team worked together? How are they successful? Is there any gaps in that experience? So let's say it's a very technical product, but you only have somebody that's just graduated from university and that's kind of your technical person. We really do want to see how does this team work together and what experience do they bring to the table. Project viability. Are we looking at either a new product or a new market segment that you're going into? That's definitely something you want to touch on in your business plan. You have identified the risks, you know what's going on in that space, and tell us what you're going to do about that. The financial strength of a company, I would say typically when we move into sort of the larger loans, we're looking for approximately 3 years of previous financial history. And so what that looks like is different trend analysis. We're able to benchmark within different companies in that industry. Just different availability of ratios that we would take a look at in terms of the only financial information we have that's sort of stable and solid is what's happened in the past. And so we're going to look to the past, but then we're also going to look at your projections to say, okay, if this is something new you're getting into, what does that look like? But based on your past successes, that's how, we're going to have to judge it as well. Investment in the business. I get this question a lot in terms of when do we come to a bank? When does it make sense? How much equity do we have to inject? This is the sort of proof of commitment. So in terms of the early days, a lot of the growth is equity. A lot of it is family and friends. You're looking at sourcing a lot of that revenue in terms of grants, scholarship programs. That's kind of where you build the momentum. And then once you've kind of proven that success out, once you have that cash flow, that's kind of when you move into, okay, now that we've seen some equity in the business, we've seen kind of the ownership is able to generate some of that cash, then we move into, okay, now that the business is doing well, it's running successfully, when can we come in at the right time to offer senior debt financing or bank financing. This can sometimes come in the form of a personal guarantee. So let's say a bank is getting in a little bit earlier stage than we wouldn't normally. We would, let's say, not just judge the business plan just on the company financials. We'd also take a look at the personal side of things and the personal assets. So I have some loans where, the financials weren't as strong as we wanted to see, so I've asked for a personal guarantee on that loan. And that's a great fit for that owner, that works with that owner, and we're able to mesh that. Sometimes it's a deal breaker for an entrepreneur, and that's fair, but we just want to figure out what works best for that business. So definitely the investment to the business is an important part of how much capital you've raised thus far. The succession plan. I definitely want entrepreneurs to think a lot about this because it depends on how you want to structure your business, what owners you want involved in the early days, to what you see this company doing long term. Do you want to IPO this business? Do you want to have it within your family business? Do you want to pass it on to different generations? Are you selling back to the management company? I mean, I talk to a lot of entrepreneurs right now as the baby boomers are getting ready to retire. They're now coming to me saying, I'd like to sell my business next year. And next year is 12 months away, and sometimes it's not enough time to get those things in place, to solidify some different relationships, increase lease terms. It's not enough time to get the maximum value of your business. And so what I would say about succession planning is really understand the direction you're thinking of going in, and then I typically recommend at least 5 years before you want to sell your business. Please talk to one of your advisors about how to put different things in place to make sure you're maximizing your value when you sell it. You never want to be kind of under the gun. You really want to retire next year. It's too late at that stage. You're not going to maximize your value on your business. So I'm just going to go into the cash flow. So we talk a lot about this, and I've brought with me a binder here that actually goes through a mock-up cash flow projection at the very center of the handout, and that just shows you a little bit more about being accountable to what's coming in, what time is it coming in, what's going out, when is it going out. A lot of times businesses are going to see different sales cycles. I always use the seasonal versus cyclical. So seasonal would be an ice cream gelato, Bella Gelateria. I mean, in the summertime, do we see that their sales are going to be through the roof, skyrocketing? Absolutely, we are going to. They're going to need a lot more growth, a lot more working capital. In the wintertime, do we see that there might be more of a valley in terms of their revenues? How are they going to sustain that growth? How are they going to keep up with their expenses? So knowing what your sales cycle looks like is absolutely imperative, because you always want to get financing in place or have that contingency in place before you absolutely need it and are desperate, because then it's much harder. You always want to be able to plan ahead and say, I might need this. This is where my projections are going. Great. Come and chat early with an advisor, because it's so much easier to put in place when things are kind of rolling smoothly versus a last minute, oh my gosh, I'm going to be short on payroll this Friday. It's very difficult. The other one, sort of the cyclical, if your business is in the cyclical industry, we see a lot of that in the tourism industry. So once kind of the boom is on and people have disposable income, great, they're able to invest in your products and services. What we find in lower income times or times when there's a bit more unemployment, we find that businesses in that industry that are more dependent on disposable income, they have a little bit more of a valley there. And so just being aware of that, being able to talk to it, because your financial advisors will ask you questions about that. And have you thought about that? And what are you doing about that? So knowing how to answer those questions is really important. Collecting from customers on time. So I see this a lot in startup businesses where you want to make the sale, you want to close that deal, and so you allow that customer to pay you in 90 days or 60 days or whatever it is. You're basically providing an interest-free loan to that customer of yours. And I understand early on you really want to make that sale and get those relationships solidified. However, you're going to be paying interest on that working capital if you take out a line of credit, and we'll talk about that later. So it's going to cost you money then to actually make that sale in terms of interest payments. And so just really understanding, are you able to take a deposit up front? Are you able to offer just different solutions to them that allow you to get a little bit more cash up front or earlier? Because it can sometimes really hamper your cash flow when you're allowing customers 60 or 90 days to pay you. And it will put some companies out of business if they give too much leeway there, and I've seen it. So We would also just want to talk about merchant providers. A lot of times with online or point of sale businesses, being able to offer Visa, MasterCard, Amex. I get that it can be, they take a portion off the top, I get it, but just you're able to, again, get that cash flow same day or next day, and it can really help you in terms of managing your expenses and your cash flow. Supplier credit. Now here's where I would say negotiate, negotiate, negotiate. I see my customers, they do not use this enough. They don't even ask sometimes. They just, oh, this is what I'm going to be getting from my supplier. I'm just going to sign on the dotted line. Yes, I'll pay them in 45 days. Yes, I'll pay them in 30 days. If you can extend terms on your suppliers, absolutely take it. Take it, take it, take it. Sometimes with a startup and they're still developing relationships with you, they don't love that. However, if you can extend terms, as long as you can push that out, great news for you. You're able to use that working capital for something else until it's absolutely necessary. So just being aware of the inflow and the outflow, really important. Keeping inventory really reasonable. This again goes back to your projection and again goes back to your business plan. How much inventory you need, what does your demand look like? If you've got a warehouse full of one type of product, you don't have room for another product, that product sitting there is still costing you money. You're paying rent on it, you're lighting it, there's heating. So can you move to a smaller space? Being really aware of your inventory and your demand cycles is really important to keeping those costs low, especially for companies that are just kind of ramping up and in that growth stage. I know you want to have enough, but at the same point, you want to also make sure that can you use 2 or 3 different suppliers to not get honed in on one supplier concentration. So if they somehow can't provide to you, you're stuck, your neck is out, you can't get that product. So diversifying your suppliers and then being able to get a little bit more of that just-in-time inventory. So financing growth, I would say the number one here, it doesn't matter where you're banking or with a credit union, go talk to them early. Go develop a relationship with them early. Tell them what you're thinking. Tell them what, be as transparent as possible because they are going to be your advocate within that financial institution. They are building a relationship with you, being able to share, what your risks are, being able to ask for their advice earlier on. It allows you to develop that relationship to anticipate needs. A lot of times you might not know what you're going to need. They can help you do those projections. They see it all the time. I would really encourage you to develop that relationship early on.
Just a quick comment on that. I think sometimes there's a feeling that everything has to be perfect before you go to the bank. And we just want to let you know, if you haven't found that already, don't carry that as an extra weight around your shoulders these days, because if you can work with a banker as part of your advisor team, so with your lawyer, with your accountant, Devon and I were even talking just before the session about how you can put those teams together, and we will absolutely do joint calls with your accountant, with your lawyer. We can give you the best advice when we all work together, and it is as early on in the process. So we want to sort of dispel one of those myths that, you only come to RBC when you're a big company or when you're really ready to grow and everything is, just perfect in your financials. I think we can offer advice and value and even connect you with other individuals in the industry that can help you get there faster.
Perfect. Thanks, Jennifer. So in terms of now the growth stage, so you're ready, you've set the foundation, you've got the right partners on board, you're now growing, you're now scaling. We'll talk a little bit about how do we want to grow, what type of funding sources are we going to use. And so what I see a lot of is sometimes entrepreneurs really want to use cash to do that growth. And what happens when, let's say we're using cash for some of those long-term strategic buys, like let's say we're using it to buy a piece of equipment. That's tying up a lot of your working capital needs, a lot of your working cash. And so it can really hinder some of those last minute expenses, unplanned expenses where you don't have that cash available. And so what I would say, and we'll talk about it a little later on, is matching the credit need to the credit product. And so making sure that we're not tying up too much cash early on in the business because it can hinder growing as you continue to grow. One of the considerations we do for capital purchases is this is going to be a long-term investment. It's real estate, it's equipment. Can we match the livable use of that asset to the term of the credit facility? So instead of doing a short-term solution for a long-term asset, you'd be able to, let's say, get an equipment lease for the lifetime of that asset. Let's say the asset's going to last 5 to 7 years. Great, well, let's break out your payments over 5 to 6 years. Let's not use, the majority of your cash to make that purchase when you're now having to use that cash in that one day. And it really hinders what you're going to be able to do later on. And so being able to match the credit need for the credit purpose is really helpful. Absolutely. More debt averse. Absolutely. A lot of times with debt, I mean, again, I know that you've just had somebody come in to talk about accounting, so I don't want to share that I'm an accountant, but a lot of different business loans and business products have different tax advantages. Write-offs, interest is tax deductible. There's different things that you can put into place that just make more sense where you can use that interest to your advantage, or you can use these different tax structures to your advantage, and it really helps to grow, to take out that business debt. So, and again, I give this example of, we don't want to buy a car with a credit card. I mean, you'd never want, right? It's just, you just wouldn't want to do it. So we don't want to buy a piece of equipment on an operating line. Exactly that, for that. We want to make sure that we're matching it to the right growth stage of the company, to the right product and service. Now here is where you brought me right into it, so thank you. So we've got a couple of different options here. I'm going to run through the majority of them. The credit cards, really helpful in terms of travel, online purchases, miscellaneous. If you've got staff, you're not always having to reimburse their personal expenses. A lot of times that's not really fair to ask staff to do that. So business cards are very, very helpful. Line of credit. So this is where we talk about the short-term working capital needs. A line of credit is used for bridging your receivables and your payables. So let's say you're paying your company, you're paying your staff, you're building that widget, you're needing to take all of these resources, which cost money, but you still haven't sold it to your end user, you still haven't actually made that sale. You would be able to dip into a line of credit as you built your product, as you did your research on some of your strategies that you're going to do for your service companies, and then as you get paid, this is where the receivable would then be put back onto your line of credit. So sometimes we mentioned that receivables can take 30, 45, 90 days to get paid. This is where it offers you that bridge in terms of working capital needs. Your payables are sometimes going out the door before you've received that payment from your customer. And so the operating line, depending on the size of it, will help you bridge that short-term gap. Payroll, those types of things.
Just one comment, and maybe Allison, we can dig into your question if we want to go a bit deeper here, but there's nothing worse than having that line of credit set up for that cash flow purpose and then suddenly seeing an opportunity in front of you to buy a piece of equipment. And so you pop the piece of equipment on that operating line and everything seems okay for a little while because you haven't maybe run into that cash flow dip that the operating line really was needed for. And then let's say you run into a cyclical issue, a seasonal issue, or something else that's going on in your cash flow. And now is where you feel the pinch a little bit because you sort of have a piece of equipment that's tying up that needed flexibility that the credit line or the operating line would otherwise give you. So I think that's when Devon talks about matching the type of need that you have with the type of financing solution, that's where we do see sometimes businesses can hamper their growth a little bit if they don't involve the bank in that conversation where we can maybe give a little bit of assistance and help and say, actually, let's structure it this way for you, and it will sometimes save you interest and prevent that downstream pinch.
A lot of times with the working capital, it's usually related more to the product and service that you're going to be generating, but absolutely it's usually tied to your checking account. So if rent does go into the operating line, it sometimes does, absolutely, because it's before you've gotten that receivable. It's before you've been paid by your customer. So absolutely it is. A lot of times the companies like to use the operating line of credit just for what specifically they're doing on their operating business. So they just want to use it to build their product because they know that they're going to be able to pay it off with the receivable. So a lot of companies want to be very careful about what they use their operating line for. They want to make sure that they're going to be able to pay it off next month when they get that receivable in.
And do companies, I don't know, do companies typically have a loan and a line of credit?
Yeah.
Oh, they do.
Yeah.
And a credit card.
Yeah. Yeah, and a lease, and a commercial property, yeah. Because there's different needs as you continue to grow and depending on where you want to see. I mean, do you want to lease your premises or are you able to buy and then have part of it owner occupied and you can lease out the other portion? I would say at the very get-go, the operating core of the business needs to be cash flow positive before you consider buying.
Oh, it
Yeah.
has been.
Yeah. So you need to be able, and we never want to overextend a customer when they're purchasing real estate. So a lot of times we ask that they have a down payment of, 30%, 40%, sometimes on that building. So it's not the same as a personal mortgage where you're able to put 5% down or 10% down and then get the CMHC insurance. It doesn't work the same way in commercial. We really want to see that core business activities are really profitable and that you have a really good down payment on there, because exactly that, we don't want them to be overextended, because they're not in the business of owning real estate. They're in the business of helping children, and that's your core, right? We don't want that real estate to hamper you. And so we really want to make sure that those customers have a really good, solid down payment to be able to finance that. You're absolutely right. We see this all the time where we'll come in, we'll be talking and we'll be, trying to win the business and fighting for that client. And they'll come back and say, Devon, I was able to get an extra $100,000 and they gave it to me with less down payment. And I said, well, based on the cash flows that you've provided to me, how do you anticipate making those payments? I mean, you would be just scraping by. So you really need to think about, yes, it's more money and yes, it's less down payment, but is it in the best interest of the business and for you and your family as entrepreneurs? I mean, we need to take a look at the whole ecosystem of, we're business owners, but we also have, families and, those types of things. So being able to make sure that you're comfortable with that, for sure. Great question. So when we take a look at taking out another loan that was more higher risk, a lot of times when that loan was put in place, let's say the financials weren't as robust, let's say you were just growing and you really needed it, right? It was really kind of core, and that's when we talk about, right? Exactly. So that's when we talk about that risk return curve. So in the earlier days, it's a little bit more risky, so the interest rate is higher. So what we want to see moving forward and taking out, and sometimes we do, sometimes we take out high interest debt for sure. What we want to know is, based on those past financials that you've had, how are you right now servicing that debt? Is it manageable? Are you just scraping by? How is the core business being able to pay off that debt right now? And then how does it make sense in terms of where you see yourself going forward? What do your projections look like? How can we move this forward? It all comes back to serviceability, and I'll really go into some of the ratios later on what we're looking for. And so I haven't seen sort of where you're cash flowing out, but it does happen. We do take out higher interest, but again, it needs to make sense for the stage of business and how that company is cash flowing. A lot of times, if it's a little bit too early for a senior debt lender to come in, that's where we run into it's a bit too risky for us. Our loans are priced to have no defaults, so we're priced very thin, prime +1, prime +2, but we sort of base that on being paid back all of it. So we don't, if one of my clients default, I wipe my entire department's profit for the year. We don't price our loans based on, we hope you pay us back. It's, we have to have you pay us back. That's why we give you an awesome rate. Do you know what I mean? So yeah, does that answer your question? So can you tell me a little bit about so you have business credit cards, you have an operating line, and was there something else?
We had a loan from BDC.
Okay.
Yeah.
Okay. So yes, definitely can get confusing when you have different financial institutions, and BDC probably was so helpful at that stage to be able to come in a little bit earlier, a little bit higher interest rate, but
I find it very high.
but they came in earlier, right? Like
Yes.
they were able to come in and support at an earlier stage than, let's say, an RBC or a TD or whatever.
Yeah.
So absolutely, can it be really confusing to be able to pay down that, because that loan is more of a term loan. So you're paying the principal off as well as interest.
Yeah.
Then you've got difference if you've locked in on a fixed rate or if you've got a variable rate. It can get, absolutely, that can be really confusing.
I feel like a lot of what we're paying stuff back all the time.
Yeah.
The interest rates are so high that I feel like we're losing out.
Yeah. Yeah. And that's a decision that a company needs to assess when they take on the debt. And this is exactly where we talk about the business plan, the business projections, because you may need that money right now. It's so immediate. I didn't plan for this. Let's get it in place today. But then if we take a look at how we amortize or how we're going to spread those payments out over time, yes, it hinders other growth. And yes, it hinders other things. So really being aware of where is it going to be tight moving forward. And a lot of times with an operating line, that's just interest only. So you're just paying, you're right, you're not paying any sort of principal payments down on that. It's just, so there's just different mechanisms to be able to understand and plan for the right growth at the right time for the right kind of plan. Do you want to?
I was just thinking probably an annual review with the bank. If you haven't done that, it doesn't hurt to go in and say, I just want to sit down and go through everything that I have and find out if there's anywhere that you can save me time or save me money. And that's a very valid question to ask. We love that question, actually. Yeah.
And I would also say that I do a lot of joint meetings with BDC and myself and my client. So we can all work together to do an annual review together. And that's where we get into that question of, is this a place where RBC can now take out that debt?
Right.
And so we can have that dialogue, because BDC is not meant to be competing with an RBC or a TD or another financial institution. They're meant to supplement and complement. We're meant to work together.
You would take out a BDC.
Absolutely. Yeah. At the right time, for sure. And so
BDC works with RBC on that, right? It's in both organizations' interest to do that and to help that client move into that more stable space, right?
And a lot of times in terms of, we can chat a little bit about the ratios, but shoring up your balance sheet to be able to say, let's say you have a loan with a BDC, and let's say you have a loan with a larger institution that's sort of chartered in Canada, they're able to subordinate their debt to us. So that then allows RBC TD or another bank, to be in first ranking position. We like that better. And so we're able to now consider that debt a little bit differently than if we were sharing the first charge, right? So we're able to do different things on the balance sheet to say, look, this debt is now, we're going to be paid back first in case anything goes wrong. We like that. BDC does that for us. And so we now consider that debt differently. Do you know what I mean? Because we're no longer equal. We get paid out first. Right? So we like that. And so there's just sometimes different terms and conditions we can put into place. We've kind of talked a little bit about the line of credit. We've gone through a little bit on the term loan in terms of, let's say it's a piece of equipment. Let's say it's leasehold improvements. We're able to then, again, match the business need to the credit product. What we find with term loans, again, they're blended. So they're principal payments plus interest. They can be variable, fixed. And they can usually be, 5-7 years, depending on the life of that asset. And that can really help kind of spread out those payments, and so they're not all in within, say, 1 or 2 years of trying to pay it down. The leasing is just sometimes a little bit different in terms of sometimes we can finance 100% of that asset. So I see a lot of brand new equipment, great. We just want to be able to kind of rent it. We don't really want to own that equipment. It's going to be obsolete in 3 years anyways. Great, let's lease it then. Again, this is where we get into the tax advantages, where you want to talk to an accountant about how you can pay that off and then write those payments off.
What happens to the equipment at the end of the lease term?
You can either buy it back if you want, or it goes back to, yeah. And then you can upgrade to the new equipment. A lot of my clients do it with servers and computers, and you're just refreshing. I mean, if you're in the tech space, that iPad is not cool anymore, so we need the Air iPad. It's just, they want to be able to refresh and get the latest gadget, and so we have a revolving lease facility so they don't own it at the end of it. They're not now carrying obsolete old equipment that's not really helpful. Yeah, so it's up to you. Leasing can be either or. You purchase it at the end or give it back.
And Jennifer, that's a great example, actually, because I've seen a client buy a dishwasher on an operating line and they could have leased it and not had it tie up that operating line, right? So lots of different options.
When I talk to a lot of investors, kind of private investors or equity investors, they want to see their money used for like growth. Yeah, I would say. Yeah, because they want to see what's that return. I'm going to quickly touch on business ownership transition. So we did succession planning. So a lot of times we've been talking about assets that we're able to take a charge on to use loans. Let's say we want to finance goodwill or intangibles or something that's, you've built awesome relationships and now you want to sell it. This is where we get into financing intangibles, and there are different loans for that availability as well. The government guaranteed, so the small business financing loan, I definitely want to mention. So this helps entrepreneurs finance equipment, leasehold improvements. It's all about modernizing, installing business equipment and helping to kind of refresh your place of business. So we use it a lot for loans and leasehold improvements. If there's real estate involved, the loan can go up to $500,000. If it's just equipment and leasehold improvements, the loan goes up to $350,000. The very interesting thing about this loan is that it is 75% government guaranteed. So the bank, it's kind of like a risk sharing appetite. And so the bank is really only on the hook for 25%, in which we would ask you for a personal guarantee for 25%. So it's a very interesting model. You can Google it. It's all over. It's just a great opportunity to use. Interest rates are competitive, and you can use, and they finance up to 90% of the costs of whatever you're buying. Or
Has everybody heard of it? Or it's called the Canadian Small Business Financing Loan. And it's a horrible acronym, CSBFL, right? But if you Google CSBFL, you'll find lots of information on the government sites.
Perfect. Okay, I'm going to run into the ratio portion, and this can kind of be, depending on how much knowledge, or if you have a CFO or if you don't, this is where some of the key things that we would look at in terms of what we want to see your financials at. So I don't know if everybody's heard of the EBITDA, so that would be earnings before interest and tax, depreciation and amortization. And the reason we look at that, sorry, I can say that again. So, sorry, earnings before interest and tax and depreciation and amortization.
And your accountant can definitely tell you what that number is.
Yeah.
And so why do we look at that? We want to be able to take the net income and add these items back into this number to be able to understand and compare profitability across industries, across companies, because we want to see, no matter what you've done in terms of financing, no matter what you've done in some of the business decisions, we want to kind of neutralize that and really understand how is the core profitability, what is that looking like? So we use EBITDA to do that. So I'll jump into the debt service coverage. This is basically just kind of your EBITDA, or your core earnings, divided by what are your obligations. So what are your long-term debt? What's your interest? What do you need to be paying off every year? And so we want to see this ratio above 1 for sure. A ratio below 1 for this means that you're not able to service your current debt. So we want to take a look at how is the company able to service the current debt, but then also the proposed debt. So let's say you've come in for a new loan, you want more money, we're going to add that into this ratio to make sure that you can still make the payments. It's not a great service to you if we're advising you to get that loan, but we haven't taken into account if you can pay for it, right? Not helpful. So we'd look at sort of current and proposed debt in this ratio. The EBITDA margin, we've sort of talked about, again, the earnings above total revenues. We want to know, again, core profitability. Not kind of some of the additional things that you're doing with your business, but what's kind of the core, and how are you continuing to be profitable? Balance sheet leverage, we use total assets over tangible net wealth. Sometimes we use total liabilities over tangible net wealth. This is going to show us how is the company right now structured? How did it grow? Did you use debt or did you use equity? How is the company structure looking? A lot of times with why I use tangible net wealth and not equity is sometimes you've invested in goodwill or intangibles. Unfortunately, the bank can't take a charge on that, and so we remove it from the equity portion. So again, it's tangible net wealth. What can we take? What's hard? What's there that we can use to be able to see how the company is structured? Funded debt leverage. Funded debt is just a nice term to say anything that you pay interest on. A BDC loan, a bank loan. Let's say it's a shareholder loan that earns interest. That's funded debt. So anything that's earning interest is your funded debt, and you want to know. How long will it take your company to pay that off? You want to know that number for sure. So this ratio helps you determine that. The current ratio, this is going to show a little bit about short-term debt, short-term liquidity. What's kind of your current assets over your current liabilities? You want to make sure that it's generating quite quickly. I would also say in terms of shareholder loan, if you do have investors dumping money into the company, it's showing right now on your balance sheet as a liability. If you can postpone that, and what that means for 1 full year, that shareholder will not ask for that money back. We call it a postponement. You can now consider that debt as equity. So that can significantly change your ratios on your balance sheet. It can really help get you more money with the bank, potentially. So definitely something to chat to your investors about. If they don't need it within the year, you can postpone that debt.
And if you are all passionate about running your business and not passionate about numbers and ratios like this, we totally understand. And the advice we would give you around that is just to get that joint call between us and the accountant, and we can go through this with you so we can really have that conversation.
Perfect. Any questions on that? We still have a few minutes. Great question. Depends on the industry. Depends on the company. Yeah, because you're absolutely right, because let's say with car manufacturers, they're going to have huge infrastructure, huge debt. Right, versus service, where they sometimes don't have the same amount of debt ratios. And so if I see a company in the service industry that has huge debt, I'm going, okay, well, compared to your competitors, why are you so much higher on your debt? So it just, again, depends on the industry that you're in and how that's flowing.
So service industry is across the board, is there?
No.
Yeah, it's different even in segments.
Very different, yeah. And again, chat to your advisor, chat to some of your core people. And I kind of mentioned a little bit about the loan application. Again, you're going to get this presentation, but we've chatted a little bit about it in terms of, 3 years financials, a listing of the accounts receivable and accounts payable, if we're doing an operating line, ownership structure. I always want to ask this: who's going to make those decisions? Who has a stake in the company? I definitely want to know this. And then business plan with projections. And then I'm actually going to end with the business protection. So I spent 5 years in the insurance industry. I've met a lot of companies that they have fire and water damage, and that's great. But let's say that loss happens and you didn't buy business continuation or you didn't buy business interruption insurance and you've had to close your doors for 3 months. That will significantly hinder your ability to do business, to pay off your debt. So just make sure you have the right coverage for some of those contingencies that can happen, because it can really, these accidents do happen and it can be unbelievable what it can do to your business. So is that business solely dependent on that individual? Is there anybody else that can come in and help if there's anything going on with that person? And life happens, right? So is that going to hamper your ability to pay off the loans, continue to do business? If, let's say, you lose the CEO and business stops and shuts down, I think that's hugely indicative of, needing some sort of insurance plan where you take that into consideration.
What about for, if somebody came after you personally, like a staff member?
So that's directors, yeah.
What would that insurance look like?
Yeah, so that's called directors and officers liability or errors and omissions liability. Again, same thing. You're right. You need to be protected depending on the size of your business, where you're operating, and absolutely there's insurance for that for sure. It's very specialized. Great question. Tough for me to answer. We're regulated. A bank cannot talk about too much in detail in terms of offering recommendations on insurance. Just, again, some of the regulations that we're under. So I would say best answer to that, we don't a lot of times have it kind of looking for the insurance on the line of credit. We're hoping that you have it in place before you even come to us. So before you even come to the bank, it should be a discussion with one of your advisors. Typically somebody will take you through like a broker or somebody like an advisor that goes through and has access to all of these products and services. Yeah.
When I got my loan, I was forced to have all of the bells and whistles with regards to insurance. Okay. And I wonder now if I had gone to a separate outside and just had all the bells and whistles through them, would it have made a difference on the amount on the
Potentially. Yeah, because there's different offerings in terms of structure, what the bells and whistles are here versus here. And then I'll just leave you with the last slide. And your financial partner, your banking partner is not just going to be lending you money. They're also going to be helping you with cash management, foreign exchange, connecting you with some people in the personal department. They're really your quarterback within the bank to be able to connect you to different departments, different services, different offerings. And so I would just say, ask the questions, make sure that you've really understood the different departments, because it can be kind of overwhelming to walk in and not know what's going on. And so there's just different support a bank can provide or a credit union can provide, not just kind of a bank loan. We're there from day one, not just when you need the money, I would say.
I think I'll just speak very quickly. The Canadian Small Business Financing Loan is really the door opener, I think, for a lot of businesses. And as Devon mentioned at the beginning, it depends on what stage the business is at, whether it's in that more startup growth phase where the personal guarantee and basically the net worth and the personal financial strength that you're bringing to the table influences the application a lot, right? Versus if you're saying, this company is a going concern, it's up and running, it stands on its own 2 feet, and so I'm looking to borrow in the name of the company without so much of that personal guarantee. And that's a really important differentiator, right? So I think the Canadian Small Business Financing Loan is honestly like the gateway for a lot of people to get going, with only having to provide the 25% personal guarantee and having the support of the government basically guaranteeing that debt for the bank, so that we can maybe be in a bit more of a comfortable place to take on a bit more risk than if we didn't have that program in place behind it. Yeah. Does that answer the question a bit? Okay. We're doing a lot of them, if I can. We've got a lot of customers we're helping in that way, so.